Yesterday, the 20 millionth Bitcoin was mined. That means 95% of all the Bitcoin that will ever exist is now in circulation. But here's what the headlines missed entirely. At the same moment that milestone crossed, Bitcoin sitting on exchanges hit the lowest level in this asset's entire history. Not a 6-year low, not a decade low, the lowest number ever recorded. Think about what that means. There are fewer coins available to buy on the open market today than at any point since Bitcoin traded below $10,000. And while retail investors have been panic selling through 5 consecutive weeks of ETF outflows, the worst institutional bleed since spot products launched, wallets holding over 1,000 Bitcoin quietly accumulated 270,000 BTC in the past 30 days alone. That is $18.7 billion in Bitcoin moving off exchanges, out of the hands of sellers, and into cold storage. The last time that signal appeared at this scale was 13 years ago. I'm going to show you exactly what the on-chain data is telling us right now, why the conventional narrative about Bitcoin's crash has it backwards, and, most importantly, what the metric I'm going to reveal in a few minutes has only done twice before in Bitcoin's entire history. Both times, what came next redefined the market. Stay with me. Let's get oriented. Bitcoin is trading at approximately $70,828 as of this morning. That's a market cap of $1.33 trillion. BTC dominance is at nearly 60% of the entire crypto market. On the surface, if you've been following mainstream financial media, you've heard one story. Bitcoin is in freefall. Institutions are fleeing. The ETF era is over. That story is incomplete. And here's why it matters. What mainstream media measured was the first 2 months of 2026, when Bitcoin ETFs bled $4.5 billion in net outflows, with February alone accounting for $3.8 billion. The worst monthly exodus since the products launched in January 2024. Headlines ran institutional investors abandoning crypto. Bitcoin briefly touched $60,500. But here's what that narrative completely ignored. The outflows happened inside a collision of macro shocks, a geopolitical confrontation in the Middle East, a Federal Reserve sitting at 3.5 to 3.75%, with a critical policy meeting 1 week away, and a market where retail sentiment crashed to a fear and greed reading of 5 out of 100. And while that was happening, while every retail indicator was screaming capitulation, something else was occurring in the data that doesn't make TV segments. It doesn't show up in a CoinDesk headline. It's the thing that separates investors who build wealth from investors who read about other people building wealth. Here's where we are in the Bitcoin cycle, historically. The 2024 having cut mining rewards to 3.125 BTC per block. That event has historically preceded major market expansions 12 to 18 months later. We are now 23 months post-halving. The structural supply compression is in full effect. New Bitcoin production is down to just 450 coins per day. And here's the metric I'll show you in a few minutes that has only flashed this reading at 2 other points in Bitcoin's history. The last time it appeared, Bitcoin was trading at $200. The time before that, it was at $3,500. I'll show you exactly what happened next, and what today's reading suggests about where this market is heading. First, let me walk you through the price structure. Let's be precise about what the chart is actually showing us. Bitcoin's current market structure is a transitional accumulation phase. After a 44% correction from the all-time high of $126,080, price found its floor at approximately $60,500, then staged a recovery rally that now has BTC wrestling with a critical decision point. The support levels you need to know right now. The first and most immediate is $69,400. This was the 24-hour low during the recent bounce, and it now serves as the floor that buyers defended during the recovery. If this breaks on daily closes, it's a problem. The second, and far more important, is $65,000. This is the major structural support, the level that multiple analysts have identified as the line that, if broken convincingly, opens the door to a deeper sell-off towards $60,000. When Bitcoin briefly dipped toward this zone in late February, it's exactly where the buying stepped in. The third support is $60,000 to $60,500. This was the recent low. A retest of this level after the current bounce would be technical deterioration, and it would also be the zone where many large wallets would likely reaccumulate aggressively based on current positioning data. Now the resistance levels. $72,000 to $72,500 is the immediate wall. This zone corresponds to the 61.8% Fibonacci retracement of the full decline from $78,988 to the $60,500 low. Multiple rally attempts have been rejected in this range. A confirmed daily close above $72,500 with volume would be the first real technical confirmation that the correction is structurally complete. The second resistance is $80,700. That's the next meaningful target if $72,500 breaks. And it's also where short-term holders who bought near cycle highs are likely to look for an exit. The third, and arguably most important resistance, is the 200-day exponential moving average, currently near $95,700. Until Bitcoin reclaims that level on the weekly, the broader trend remains challenged. Now, who is buying at these levels? On-chain data is unambiguous. It's not retail. The accumulation profile of recent weeks shows wallets in the 1,000 plus BTC category have been the dominant buyers. These are not day traders. These are long-duration holders making calculated, high-conviction entries during periods of maximum market fear. Who is selling? The on-chain evidence points to two groups. First, short-term holders, people who bought Bitcoin in the $80,000 to $100,000 range and capitulated during the $60,000 test. Second, some ETF redemptions, where institutional allocators reduced exposure during the geopolitical shock event. The selling was not coming from long-term holders, whose supply has barely moved. Exchange reserves provide the clearest picture. Bitcoin on centralized exchanges just hit an all-time low. There are fewer coins available to buy on exchanges than at any point in Bitcoin's entire history. At the same time, demand, as evidenced by the March ETF inflow reversal, is returning. You know what that combination is called in every commodity market in the world. If you want to catch these signals before they become obvious to everyone else, you know where to be. Let's talk about what large capital actually did versus what was reported. The reporting focused on ETF outflows, and those outflows were real. For $0.5 billion out of US spot Bitcoin ETFs in the first 2 months of 2026, the 5-week outflow streak was historic. The February total of $3.8 billion was a record. But here's the critical intelligence layer that wasn't covered. On March 2nd, all 12 US spot Bitcoin ETFs recorded net inflows on the same day, with zero outflows across every single product. That's the first time since the ETF launch that every fund moved in the same direction simultaneously. The total, $458 million in a single session. Then March 4th delivered $461 million. 3 consecutive days of strong inflows totaled over $1.1 billion. That is not the behavior of an institutional class abandoning Bitcoin. That is the behavior of institutional capital that waited for the washout, watched the retail capitulation, and then moved back in size. The wallet data from the past 72 hours tells the same story from a different angle. Wallets holding 1,000 or more Bitcoin, the threshold that represents serious capital, not hobbyists, net accumulated 270,000 BTC in the past 30 days. At current prices, that is approximately $18.7 billion in Bitcoin moved off exchanges and into cold storage. This is not trading activity. This is long-duration accumulation. These coins are being removed from the market. One major financial institution filed with the SEC for its own spot Bitcoin ETF during this same period, naming established custodian relationships as part of the structure. This isn't a startup move. This is a $100 plus billion institution saying, formally, that Bitcoin deserves a seat in client portfolios. Now consider what that combination actually means for the supply side. US spot ETFs collectively hold approximately 1.3 million BTC, roughly 6.7% of total supply. Corporate treasuries hold another 1.1 million BTC. Whale Cold Storage absorbed another 270,000 BTC just this month. You are looking at an effective float that is shrinking in real time, even as exchange reserves hit their lowest point in history. The last time wallets of this size accumulated at this pace was during the 2018 bear market bottom, when Bitcoin was trading near $3,500. Within 18 months, it hit $14,000. Within 36 months, it was above $60,000. I'm not drawing you a straight line between then and now, but the pattern of who does what and when, that's a language the data speaks consistently. Bitcoin doesn't live in a vacuum, and in 2026, it lives inside a macro environment that is actively reshaping how it behaves as an asset. Here is the Federal Reserve reality right now. The target rate sits at 3.5 to 3.75%. The March 17th to 18th FOMC meeting, 1 week away, could be the most consequential monetary policy event for Bitcoin since rate hikes began in 2022. Markets are currently pricing approximately 2.5% in total cuts through the remainder of 2026. That's not a small shift. That's a full-cycle reliquefaction of the financial system. When rates fall and liquidity expands, capital moves from yield-bearing instruments into risk assets. Bitcoin, which now correlates with the Nasdaq at approximately 85%, responds to this mechanism faster than most traditional assets. The US dollar index is under sustained pressure. As the dollar weakens, Bitcoin denominated in dollars benefits from a structural tailwind. Capital seeking non-dollar alternatives flows into gold and, increasingly, into Bitcoin as a complementary hard asset position. CPI and PPI data have shown sticky but declining inflation, which places the Fed in a position where rate cuts are justified without triggering panic. That is the Goldilocks setup for risk assets. Inflation retreating, rates falling, liquidity expanding. Every one of those factors is a tailwind for Bitcoin. But the macro picture is not one-dimensional. Oil prices have surged above $100 per barrel following Middle East tensions. That keeps inflation elevated and complicates the Fed's path. Markets are in a genuine tug-of-war between liquidity optimism and geopolitical stress. On the regulatory front, the crypto industry received access to the Federal Reserve payment system on March 5th. That is a structural legitimization event. Additionally, 92 crypto ETF applications are awaiting SEC decisions with a March 27th deadline, including products that would expand institutional access to digital assets beyond Bitcoin. The Bipartisan Genius Act governing stablecoins is moving toward law. Market structure legislation for digital assets is advancing in the House. The regulatory environment in the United States, which was a headwind in 2022 and 2023, has now become a tailwind. The honest answer to whether macro is a tailwind or headwind for Bitcoin right now, both operating simultaneously at different time horizons. Short-term, geopolitical stress and pre-FOMC uncertainty create volatility. Medium-term, falling rates, declining exchange supply, and institutional accumulation create a structural bid. Now here's where it gets interesting. This is the layer that separates informed positioning from expensive guessing. Bitcoin on centralized exchanges just hit an all-time low in recorded history. Not a 6-year low, not a 2019 level. An actual all-time low, approximately 2.4 million BTC across all platforms. Since early 2025, exchanges have lost over 1 million BTC to ETF custody, cold storage, and corporate treasuries. At 450 BTC mined per day, it would take over 6 years of total production to replace what left exchanges in the past 12 months alone. When available supply shrinks and demand returns, that is the textbook setup for a supply shock in any market. Now here's the metric I teased at the beginning, the one that has only appeared twice in Bitcoin's entire history. Bitcoin's weekly RSI has fallen to 27.48. That is the lowest reading since December 2018. The weekly RSI has only fallen below 33 times in Bitcoin's entire recorded history. January 2015, Bitcoin was trading near $200. What followed was an 8,400% rally over the next 4 years. December 2018, Bitcoin was trading near $3,500. What followed was a 3,500% rally over the next 3 years. And now, March 2026, Bitcoin trading near $71,000. Both prior instances coincided with long-term cycle bottoms. Both preceded multi-year bull markets. That does not guarantee a repeat. It does demand your attention. The Fear and Greed Index hit 5 on February 23rd, the most extreme fear reading in this asset's modern history. It spent 22 consecutive days below 25, a streak matched only twice before, and both prior instances preceded substantial recoveries. As of today, the index has moved into greed territory, a dramatic reversal that typically signals the sentiment floor is in. During the worst of the correction, funding rates across all major perpetual futures went deeply negative, meaning short sellers were paying long holders to keep their positions open. That is the signature of a crowded short trade. When short trades get crowded, they become explosive in the other direction. The recent bounce from $60,500 to $70,000 plus was, in part, the mechanical consequence of that squeeze. 68% of all circulating Bitcoin has not moved in 155 or more days. Long-term holders are not selling. The selling pressure of recent weeks came almost entirely from short-term holders who bought above $80,000 and capitulated. That seller pool is now largely exhausted. And one more thing on the supply side that almost nobody is putting in context. Yesterday, approximately the 20 millionth Bitcoin was mined. Only 1 million BTC remain to be produced, and they will take 116 years. Bitcoin's annual issuance rate is now below 1%. At 450 coins per day, the entire year's new supply could be absorbed by a single day of moderate ETF inflows. This type of analysis, the data that separates informed decisions from emotional ones, isn't what gets amplified by algorithms. It's what actually moves capital. This is the work we do here every time. History doesn't repeat in crypto, but it rhymes loudly enough that you'd be foolish not to listen. In December 2018, Bitcoin's weekly RSI fell below 30 for only the second time in its history. The Fear and Greed Index was pinned in extreme fear. ETF products didn't exist yet, but the institutional equivalent, large OTC desk activity, was showing similar accumulation patterns from high net worth buyers. Sentiment was apocalyptic. The prevailing view: Bitcoin was dying. Bitcoin was trading near $3,500. Within 18 months, it reached $12,000. Within 24 months, it was at $29,000. Within 36 months, it crossed $60,000. In March 2020, Bitcoin crashed 50% in 24 hours as COVID uncertainty hit. Fear and greed collapsed. Exchange outflows surged as long-term holders refused to sell. Whale wallets accumulated aggressively. Funding rates went negative. Exactly the same configuration as today, just compressed into days rather than weeks. Bitcoin went from $3,800 in March 2020 to $69,000 by November 2021, and 1,800% move from the fear low. In both cases, the divergence pattern was identical. Retail capitulation, extreme fear readings, whale accumulation, negative funding rates, followed by a structural reversal once the macro catalyst arrived. Today, the macro catalyst on the calendar is the Federal Reserve FOMC meeting on March 17th to 18th. I'm not saying history repeats. I'm saying the data rhymes. And right now, it's humming a very familiar tune. Here is the strategic framework you need to navigate the next several weeks. Not predictions, a map. 3 price levels will define Bitcoin's next major move. $72,500 is the immediate decision point. A confirmed daily close above this level, on expanding volume, would represent the technical completion of the current base and open a clear path toward $80,700. A failure here, a rejection that takes Bitcoin back below $70,000, suggests the basing process needs more time. $65,000 is the line in the sand for the bull case. If Bitcoin closes a daily candle below $65,000 during the FOMC week, the accumulation thesis is under serious stress and a retest of $60,000 becomes the operating scenario. $80,700 is the first target if $72,500 breaks. It's also the level where many institutional algorithmic models would generate by signals, potentially accelerating a move. The catalyst to watch in the next 3 weeks. March 17th to 18th is the FOMC meeting. Markets are pricing a hold with dovish forward guidance. If the Fed signals accelerating cuts or explicitly acknowledges market stress, That is a liquidity injection signal that historically accelerates Bitcoin moves within 2 to 4 weeks. March 27th is the SEC ETF decision deadline. 92 crypto ETF applications. If even a fraction receive approval, the expansion of institutional access pipelines creates a demand catalyst at a time when supply on exchanges is at historic lows. And ongoing, the weekly ETF flow number is now the single most important short-term market signal. When weekly inflows exceed $1 billion and sustain for 2 or more consecutive weeks, that is the trigger that historically correlates with 3 to 7% price appreciation within the following 10 days. The bull case, Fed signals accelerating easing. The DXY weakens. Risk capital flows into Bitcoin. ETF inflows accelerate. Exchange supply, already at an all-time low, cannot absorb demand. Supply shock dynamics drive price toward $80,000 to $90,000 by Q2. The bear case, FOMC holds and signals no near-term cuts. The DXY strengthens. Bitcoin loses $65,000. Short-term holders who survived the first leg of the correction capitulate. Price retests $60,000. If $60,000 breaks, $50,000 is the next structural support. The one on-chain signal that tells you which scenario is winning. Watch exchange reserve changes on a weekly basis. If reserves continue declining while ETF inflows are positive, the bull case is winning. If reserves stabilize or reverse, meaning coins are flowing back onto exchanges, that is early warning that distribution is returning. If exchange reserves keep falling and ETF inflows return, expect supply shock dynamics to accelerate. If exchange reserves stabilize while ETF inflows stall, watch for a retest of the $65,000 zone. That's your framework. Keep it simple. Trust the data over the narrative. Here is the single most important thing to carry out of this video. The Bitcoin market just completed one of the most significant sentiment washouts in its entire history. A fear and greed reading of 5. The weekly RSI at 27, a level seen only twice in 13 years. ETF outflows matching the worst periods of the 2022 bear market. Retail conviction near zero. And in the middle of that, while the narrative was institutions are leaving, the largest 30-day whale accumulation in 13 years was occurring beneath the surface. This is how Bitcoin has always worked. Not for the loudest voices, not for the people chasing headlines, for the people watching the actual data, where capital physically moves, not where commentators say it's moving. Here's the behavioral truth of the moment. Most retail participants right now are doing one of two things. They're either panicking out after the correction, locking in losses, vowing to come back when it's safer, or they're waiting for the all-clear signal, some definitive moment when everyone agrees the bottom is in. The all-clear signal never arrives in time to matter. By the time mainstream media declares Bitcoin's recovery, the move has already happened. The addresses that accumulated 270,000 BTC don't wait for permission. The one thing that consistently separates investors who build wealth in volatile assets from those who don't isn't intelligence. It's not even timing. It's the discipline to interpret data without emotion, to see what's actually happening, not what the market feels like is happening. Right now, what's actually happening is this. Supply on exchanges is at an all-time low. The 20 millionth Bitcoin was just mined. A 13-year record whale accumulation occurred during extreme fear. And the Federal Reserve is 1 week away from a meeting that markets believe will signal the next phase of monetary easing. Those are facts. The rest is noise. The people who saw this setup coming were watching the on-chain data, not the headlines. That's what this channel tracks, week in and week out, so you don't have to do it alone. The market doesn't reward the loudest voices. It rewards the most prepared minds. One final data point that almost nobody in the Bitcoin space is talking about today. Only 1 million Bitcoin remain to be mined. Ever. At the current rate of 450 coins per day, it will take 116 years to produce them. Meanwhile, exchange balances, the immediately available supply, hit their lowest level in Bitcoin's entire recorded history this morning. Next week, I'm watching one number above everything else, the ETF flow total for the week following the FOMC decision. That number will tell us, in real capital terms, whether the institutional reentry we saw in early March is a genuine trend reversal or a temporary bounce. The data will be honest, even when the market isn't. we'll have it for you.